What's up, everybody? Michael Silva here. You are watching the Stock Market Brief Show. Today's episode, it's titled, Don't Fight the Fed. And here's why. We're going to discuss it on today's episode. In the news, well, we were berated by a bunch of Fed officials. Back another large rate increase. This right here is Christopher Waller saying a significant interest rate increase is necessary to get the policy rate to a setting that is clearly restricting demand. Fed's George say central bank must press forward with increases. Fed's Evans open-minded on the size of a September increase. And of course, Fed Powell affirms the need to act strongly to fight inflation. Meanwhile, the ECB rose interest rates by a historic 0.75 basis points as Europe stares at a recession. An interesting article by MarketWatch, published on MarketWatch, says the wild card that could sink stocks. Well, if you open up that article, the Fed has begun shrinking its balance sheet, and here in September, it's set to do its maximum rate of $95 billion per month. So that is looking at $60 billion of treasuries, $35 billion of mortgage-backed securities rolling off the balance sheet without reinvestment. Now, they did point out very similar the unwinding of the Fed's balance sheet back in 2017, right? After the economy had long recovered from the 2008-2009 financial crisis. That was when Janet Yellen was the Federal Reserve chairman, and it was kind of a ho-hum event, as they stated. But it wasn't until fall of 2019 when the Fed had to inject cash into the malfunctioning money markets. That's when quantitative easing then resumed. So they went, and then it broke. What is the Fed Watch Tool telling us? The Fed Watch Tool is telling us there is a 91% chance of a 75 basis point hike versus a 9% chance of a 50 basis point hike. So chances are on the September meeting, we will be getting another 75 basis point rate hike. Holy moly, gonna keep this train going until something cracks. Now, if we take a look at the Fed website, once again, this over here, this blue line, this is the Fed balance sheet. And clearly, from these points right over here, is when it really started tightening. And, you know, it's a really slow roll-off right here, but look at just how fragile the stock market is. And by stock market, I mean the S&P 500, how it's just seeing this turbulence, right? Back and forth and back and forth. And even here, we just had a recent run-up in the week, even despite the Fed balance sheet tapering off a little bit here, okay? So yeah, don't fight the Fed. If this is going to continue, which it's stated that we're going to raise interest rates and we're going to be tapering off the balance sheet, what do you think the S&P 500 is going to do? Should you trust this rally to the upside? Well, we'll look at where it can go because we also knew that it was way overextended and a bounce was coming out. On the calendar, we have some major events coming out next week. We have the big one is inflation data. We have PPI the following day. That's September 14th. We have retail sales, and we have U.S. consumer sentiment as well. So quite a bunch of stuff going on as far as economic data goes. The inflation report is going to be one of the bigger ones. So I want to talk about that very quickly here. Consensus is estimating an 8.1% going into this next report. And, you know, many people are saying this right here was peak inflation, 9.1. We've been kind of saying that, okay, yeah, even if it's peak, it doesn't mean it's going to come down to 2%, which is the target goal, right, in a matter of a few months here. So what we see is, you know, this kind of toss between 8 and 9, this very sticky area right over here. So consensus is saying 8.1, but what I find interesting about this is if you look at the Fed's nowcast, this is actually, and if you look more specifically right here, right, boom, the inflation year over year percentage change, they're forecasting 8.22% in September, which is higher than consensus. So the Fed is actually higher than consensus, and that to me is kind of interesting. So I wonder what's going to happen to the markets if inflation comes in a little bit hotter than expected. All I know is to just let the market digest before just trying to blindly enter in a trade it could be very binary at that point. So be very careful and aware when that comes out, and that will come out 1 hour before the market opened. That's the inflation rate year over year, okay? And then the core inflation rate year over year too as well will be at 5:30 a.m., which is a market an hour before the market opens. So be well aware of that. Let's take a look at a weekly recap. We're going to look at some various indices and also the sectors. As far as 1 week performance goes, tell me this doesn't look like a squeeze. Every single sector up, a high degree of correlation in the markets, right? Everything was overextended pretty much, and now we're getting a pretty nice bounce. And the S&P 500, it actually finished outside once again of its weekly risk range, just telling us that this market is very inefficient right now as far as pricing risks in. This is 3 weeks in a row, which is a very rare event. And if you look back a couple prior other weeks, it's like 4 out of 6 weeks where we're finishing outside the weekly expected moves. We do have a pretty bullish type looking candle. So in my opinion, I don't think that this is just going to be, the high right here, and then we're going to just start heading right back down. I think we can press a little bit higher, which will zoom in on the daily timeframes and talk more about that. Qs finish right below the weekly 5 EMA. Now on last weekly recap episode, we had discussed that it was closing way below the weekly 5 EMA, and that was one of the most frequently tagged EMAs, and we talked about that on all those charts. Well, guess what? We snapped back and we reconnected with it. Said, don't be shocked if that happens. And, well, are you shocked? I'm not shocked. It is a nice big bullish, outside trading candle, bullish engulfing, whatever, and this can, potentially lead to more upside. But I do want to point out that, on this rally up, right, a lot of bullishness created, and it trapped a significant amount of people that were, late to the party, bullish, these, uninformed volume getting trapped up in here. So you never know. This bounce, right, with all this trap supply up here, you can very well get the bounce up, and they're going to look to potentially sell and, maybe make up for some of the losses that they've been doing and take advantage of the market's bounce. So we'll see what happens there. Dow Jones Industrial Average, same thing, right? It finished up 2.66% on the week, right below that weekly 5 EMA. Transports up 2.35%, did not connect with the weekly 5 EMA. IWM finished up 4%, closing just above it, so pretty bullish looking there too as well. Semiconductors did not even reconnect with the weekly 5 EMA, but it did finish up 4.71%. Biotech had a huge week, up 5.95%, just smoking right through that weekly 5 EMA, creating somewhat of a, bullish type candlestick pattern, this 3-bar candle stick pattern. I believe it's called like Morning Star reversal, I believe it is, where you have a big move down, you have somewhat of an inverse hammer candle or a hammer candle, and then a very strong next candle right there, and that's what we got. So this could indicate that we could very well see some more upside in biotech. Understand that the main area to watch for, though, is right about 135 here. Okay, it acted as a level of supply. Other technicians might look at this and say, hey, it's creating, an inverse head and shoulder, and then right over here, right, we had the double bottom, and then if this breaks out, hey, we can go screaming higher, and that's always a possibility and something to keep on, just in the back of your mind. 10-year yield continues to press higher and higher. Look at it had a new weekly closing high right over here. We closed at 33.21, which is 3.32 on the 10-year yield, right? This isn't good for tech, and we're potentially breaking out here where we can head higher. And if this continues to head higher, obviously, guess what? Tech's going to get hit again. If you take a look at TLT had a capitulatory type move, and now we're kind of just potential double bottoming right here. It wouldn't be really considered a double bottom until we start clearing back over here. So as it stands right now, we're just range bound. You can see, we came down, tagged up, came down, tagged up, tagged down. Now we're going to come back up, maybe a little bit of a relief bounce to reconnect with that weekly 5 EMA, because we're pretty far off of it. And you can see that is the very same situation right here where we reconnected and saw a little bit of a bounce. So if that is the case, that means the 10-year yield is going to be backing off a little bit, and that might offer up a little bit more relief in this current rally. But meanwhile, if you take a look at the dollar on the weekly time frame, it has been just on a monster move to the upside, putting in higher highs and higher lows. This week had some pretty big volatility, hitting a high of 110.79, still above a weekly 5 EMA as it held its support, but this could very well be a reversal type candle in the making right here. So if we get some follow through down past 108, then we got to start looking towards around 107. But even if that's the case, okay, even if it comes down to 107, that's still what? it's still a higher low. Okay, so it's nothing to be too overly, bullish or excited about. If you take a look at WTIC, this right here put in an interesting weekly candle, an indecision candle. So we've been moving down pretty much, boom, since actually really the peak right over here when the Russia-Ukraine news came out, right? So we saw this big blow off top, came back up. Now, the thing what I'm seeing here is if we start getting above the high, all right, that's 90.39. I would imagine with oil moving up, that means I would expect to see the 10-year yield rise. Okay, that means tech down. Oil goes up, right, with the 10-year yield, right? That means energy typically outperforms too. And this is a potential, reversal type candle in the making, right? So we have these big, strong bodies to the downside. A small body creates, indecision, saying, hey, is the momentum slowing here? This is very similar to what happened to actually copper, right? Actually, I'll just bring up that chart now. Copper, that is not copper. That is not copper. This is copper. So copper, we talked about that actually very specifically on this candle right here on the daily right here, and says this could be a part where we consolidate or it's a potential reversal type move. And then we saw that move to the upside. And actually, being that we're here now, I'll just talk about Dr. Copper. We do have a reversal type candle in the making here. So if we start getting back below the low here, this could indicate that we can come right back down. And we know how the S&P 500 reacts, as you can see with these red lines. When copper gets hit to the downside, S&P 500 typically follows. So this is all lining up for, yes, we have some relief. It's working off overextensions. It's all, part of the process, especially here in a bear market. Where was I over here? Yeah, we went through IBB, we went through 10-year yield. Okay. We went through dollar, we went through oil. Let's take a look at gold. Gold over here too. It hasn't actually re-tagged this bottom, but this could still be considered a double bottom, at least in the works. But we would have to get back above 1820 to really call it a double bottom and get a little bit more bullish. Right now, all we saw this last week was an inside trading week, okay? So remember, expansion leads to contraction. So we had an expansionary type move, and now what we're doing is contracting. So what do we got to wait for? If you're bullish, we want to get above the high of this candle, back above the weekly 5 EMA for a potential stronger move to the downside. But if it starts taking out the low, which is 1700, I would say that we're going to go probably test the previous low at around 1680. If you take a look at silver, also seeing a nice big bullish type move. We were prepared for this. I think it was last week or the week prior because they move hand in hand with the miners. But it was up 4.95% on the week, but we didn't even reclaim the 5 weekly EMA. We just tagged it. Okay, Bitcoin had a big day. It was up like 10%, and that made it up for the week 7.55%. So we're getting a little bit of a relief bounce here too as well. Quite a powerful move, but overall, if you just look at the trend, right? Don't get all FOMO'd into this kind of stuff. Candace head higher. I can expect, if we get some follow through, we can go retest 24,000 probably pretty easily. But overall, it's still within a downtrend, and it could be very well just a bear flagging type pattern in the making. If you take a look at ARK, up 9.88%, working off this last 3 weeks of pretty much straight to the downside, and still over here too, right? It could be just very well just flagging. We broke down, and now we're getting some sort of a back test. Maybe does something like that. Who knows? And then potentially heads lower from that point. Let's look at expected moves on the week, but we're going to start from a larger time frame just to get a good picture of this. Now, this is a quarterly chart. Our quarter ends here in September. We typically, which I've shown you prior to this, if we get 2 quarterly closes, below the quarterly 5 EMA, that was the last times that happened was leading into the financial crisis and leading into the dot-com bust. Okay, don't fight the Fed, all right? When this happens and the Fed is already saying what their plan is, the other times it has happened, was right here, right? It closed in 2020. You get one candle close below it on a quarterly basis. So when you get one candle close, if you go back, dating back to the dot-com bust, the Fed has stepped in every single time. Now we're getting we already got a quarterly close, and the Fed is not backing off. Okay, so that means if we get another quarterly close, it lines up only through history that we have some continued, market downturn or something bad potentially takes place where they're tightening and something potentially breaks. So if we want to be, cautious in this environment, I would suggest to do so given the fact that we're still off and we don't have much time left in the month, but we have enough to reclaim that quarterly 5 EMA, which would be, in my opinion, a little bit more bullish than what we're currently seeing right here. Now, the lines on the screen are the quarterly. So I'm going to just look at the dash ones and then we'll zoom in on the month. But on the S&P 500, the quarterly expected move, we tagged it on the upper edge. So if we come back to it, it's just at about 4,000, 250, we'll call it right there, okay? And then on the downside, it's around 3,400. So that would be very incredible to see a move like that take place. But if we look at the month to date, we're still right there at that 5 EMA. So this can act as a potential level of resistance. And then on the upside for the monthly expected move, which is the solid line is right at about 4,200. So if we get a continued rally, pay attention to 4,200 as a potential area for that to stall out there too as well. If we take a look at the daily time frame for the S&P 500, the weekly expected move is just above 4150 and to the downside 3950. Overall, we are still in a downtrend. We're getting a relief bounce, right? So we had 3 days of a move higher. This is where you got to really think tactically, right? The market was getting hit to the downside, all right? And what do? We started thinking ahead of time, right over here, about a potential bounce to come because it needs to work off some overextended areas. So despite the Fed's hawkishness behavior and not fighting the Fed, it does not mean that the market can't see some rip your face off rallies. And that's exactly what we got. And there's a very strong possibility that we still can rip even higher right as it stands, okay? But even if we start ripping higher, it's still overall, like I said, in a downtrend, okay? If you take a look at the SPY, it's just above 415 on the upside, 395 to the downside. Let's hop into the Qs and we'll look at the quarterly, monthly, and then also the daily there too as well. So from a quarterly basis, we have about 320 for the quarterly expected move, all the way down to 240. You can see we're below the quarterly 5 EMA, and if you pay attention even closer, we have a PPO, it did have a bearish crossover, so wind is at our face right now from the long side. If we start moving up higher, 320 on the Qs could be a potential stall point there. If you look at the monthly time frame, the upper monthly expected move is right around 322, so a lot of confluence up in this area. We're still below a monthly 5 EMA too, so if we start rising up in this area, this could be a potential area to start looking to short again, especially if you want to take advantage of these bear market rallies, which they are bear market rallies until it's proven innocent, right? Or until the bear market rally is becomes a bull market, then we can get a little bit more bullish. But as it stands right now, the wind is still at our face. If we take a look at the daily time frame, it comes up to around 316, 317. So by the way, we're getting works off of these overextensions, but this entire area here in the Qs is met with a weekly expected move. It's met with a quarterly expected move. It's met with a monthly expected move. So if it comes into this area and it also lines up with prior resistance up here where the Fed came out and talked, right? It came out and talked right over here. And then we had this little head and shoulders. It would just be a back test. So this area right here can act like a very strong level of resistance. Even more to add to that, if you take a look at stuff like prior back to the chart, it was also a previous prior area of support. So if we come back up into this area, which is more than possible to see, all right. And by the way, like if you're thinking what I'm thinking, if you want to know what I'm thinking, I should say, I think that we are going to press higher. I think we're going to push higher unless something happens over the weekend that can gap us down and move us lower. But as it stands now, I think we press a little bit higher in this rally, could suck in some more people, and then the people that got caught up in here are going to potentially look to either, it's going to be trap supply. So as the market moves up higher, they can sell into that saying, okay, now I'll cut my losses right here, get a little bit nervous. And when we get met with more sellers, what can happen is and more short sellers, we can have some very extreme type moves back to the downside, okay? That's kind of just my thought process right now. That doesn't mean it's going to happen, but that's my thought process. IWM below the quarterly 5 EMA. It's below the quarterly expected move. It's not too far off. That lines up to just above 190. It's to 192-ish. Okay, so if we come up into that area, that's also a level of confluence. If we take a look at the monthly time frame, right, the prior candle was not too shabby, or not too good, I should say, at all, right? It was this reversal type candle, and now we saw some follow through, now we're starting to move up. So if we start moving up higher, can it hit the upper monthly expected move, which is just above that 190 marker, and that could be a potential area to start looking for shorts there too as well. If you look at the daily time frame, right, we're getting a nice big rally right from this overextended move to the downside, and we could potentially hit the upper expected move 192.50, which lines up with what prior supply up in this area, and it's below a declining 200-day moving average. We do have like the MACDs on these charts, right, curling over, so it's some bullish momentum to the upside. Just, like I said, it's don't fight the Fed here. Just don't do it, right? We can see, we can get rallies, but we will know by looking at various indicators when things start to get overextended again, okay? Now, if we get into the indicators, I want to call out the summation index. Typically, when we cross down through through zero, so if you just look at this zero line right over here. All right, so if you cross down through the zero line right here, we have seen rallies that occur pretty soon right there afterwards. So we cross down through the zero line, we're starting to see a little bit of a rally, but be aware that the parabolic SAR, it's still in a bearish trend. So we're seeing a move up. You don't want to get a little bit more bullish until we start getting the parabolic SAR start ticking back down underneath the summation index, and then this maybe can start turning back around, come back up to the upside. Now, I want to preface this with also something that most people won't, think of, but I want to call it out on more specifically the summation index for the NYSE, which is a broader market. Now, the reason why I'm calling this out is because of this. If, say, the summation index starts curling back around, all right, as we cross through zero and the market's rallying, if it starts coming back around, it's going to be hard work to take out this prior high over here, okay? So if the market continues to press higher, boom, 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 and even gets above this high, what you'll have here is, a higher high in the index, but most likely you'd have a lower high in the summation index. Now, why is that important? Well, it's important because the very same situation happened here that gave us a heads up for the June bottom, okay? We had the summation index put in a higher low. Meanwhile, the market itself was putting in a lower low. This gave us indication that, hey, this could be potential. This is a positive divergence, and we may see some sort of a bounce. And that's exactly what we saw. We saw a bounce, smaller move to the downside, and then we got that big rally right there. Okay, so as it stands, we're back below zero, small curl here as the market's trying to press higher, but that would be something to watch, moving forward. Now, here is the Pring Bottom Fisher. This is the indicator that was in my thumbnail. I want to go over a couple of things here. So when the Pring Bottom Fisher, which is down here, it's the blue line, the green line is the 10-period moving average. When it gets up to this range up here and starts crawling back around, so 250, this range right here, okay? I wanted to call this out. We called it out last time we talked about it. When it starts curling back around, the market has sold off. So you can see it sold off there, it sold off there, and it sold off there, the blue lines, okay? However, one of the times, which was on this chart at least, one of the times right here, the market kept on actually pressing higher, okay? And the reason why I show this was because at the time when I showed this was curling back around, and I said, hey, when this curls back around, it could indicate that we can get to the sell side. However, it didn't do it right here. Here, the market pressed higher. Now, what I find so interesting about this and why I'm bringing it back is because notice what happened here on this pink kind of this line right here, okay? So we're calling out this move to the downside right here. Notice how it kind of kinked, it started moving down, right? But the market started pressing higher, boom, and then it kinked right about here, okay? Well, very similar when we started crossing down. Look at it, started moving down, it kinked a little bit, and the market was pressing, obviously, higher, okay? Look at how it continued to press down further, and then the market, boom, got hit to the downside. And now look at, right, as it moved down further to this overextended area, boom, right, to the downside. Okay, so very, very similar. Now, why am I pointing this out once again? Is because when the blue line right over here crossed down through this more overextended area, which is around -10, the market actually rallied again. You can see that highlighted in pink. Okay, now what? We crossed down through 10 over here, the blue line, the signal line, and now the market is rallying once again. What ended up happening when the green line got down there is the entire move was then reversed, okay? And then we had this blow-off move. This blow-off move we actually talked about on this specific day. We got a buy signal from another indicator. That right there was the Christmas rally, okay? So that entire rally got faded as soon as that green signal line came down a little bit further. So this, to me, it's almost like, and this is what really kicked off the big bear market here going into 2022. So what I find interesting here is a lot of people are calling, the market's bottom, it's already in, whatever. Well, I'm saying, hey, don't fight the Fed. They're tightening until otherwise or until something breaks. What we got here is a very similar And this is all we can go by, right? This is how the mines work. This could be noise, but to me, this looks like it could be a potential signal, and we got to at least pay attention to it because history is all we got right now, okay? And this is pretty spot on. But okay, the whole move got rejected. So if this continues to press down further, I'm thinking that this whole move right here, it's all going to get faded. Even if it presses up higher, all right, it can still very well easily get faded. So we got to be just high alert moving forward. Now, the BP-SPX charts, I want you to pay attention to one thing and one thing only, the RSI down here, all right, and where it's at currently, okay? The reason why I'm doing this is because, right, when it was moving down to overextended, we talked about it, and we said, this is where you do not want to short, or you want to consider covering. Why? Because you don't want to get trapped in a bear market rally or get your face ripped to shreds, right? We talked about, okay, this doesn't mean that you necessarily got to go long, but it's a place to consider managing your risk. All right, so now we're moving up. Where can we potentially go? Well, if we start getting back to 70, well, be careful, and that's what we're going to then, once again, talk that we're getting overextended to the upside. BPNDX, strong move. It's at now 58.49. In a couple of days, this can reach 70, which would be what? That overextended area. If you take a look at BPINFO, this is the technology sector, also pretty strong, 55. So this is saying that there's more upside here to get to that 70 level. So be aware of that. Consumer discretionary, another big sector. It's above the 50 marker, which says, hey, we can still have some more room to go into that overextended area. If you take a look at growth to value, right, although we're getting a pretty strong move in growth, value is also doing decent. And you can see here, we're not above 0 points. So that's also a little bit concerning. If this crosses through 0, maybe that gives us a little bit more juice in this specific tank. If we look at Saylor to Schiff tool, we had a very strong day the other day. And now as it stands, we're once again turning back up, but we're not quite through the 0 line, which is right here to activate a buy signal. So we'll continue to watch that and see what develops here with Bitcoin. I want to close this off by going into some volatility charts. Okay, keep in mind we closed on Russell volatility. Russell volatility closed 27.29. So it's not even too far off from 30. This is where you're going to get whipped just like crazy. All right, so despite the rally that we're getting, volatility still remains high. If you look at NASDAQ volatility, it's at 29.23. Okay, so if you were very bullish on these last few days of a rally, which we were preparing for, right, pay attention to volatility. It's still higher than heck. Close at 29.23. This is where, you can still get hit incredibly hard, right? So when volatility is high, you need to volatility adjust your position sizing, adjust your risk, and how you kind of go about the markets. Volatility, the VIX index, is at 22.79%, which is still in the 20s, and this is also, it's not as high as the other products, but it's still rather high up there. Now, one last thing I want to look at is the VIX term structure. Look at, it's still in contango. So if you want to, like, hey, when is there going to be capitulation? When, maybe we should consider going long or adding in, a bigger position to go long. I would say we need to pay very close attention to whether or not we go into go into backwardation. And what that would look like is the front month right here, right? So October, or it depends on when it happens, this dot would be above this dot, all right? And you would get some spike here, which would indicate that there's more fear, more panic now being priced in now than there is in the future. But as it stands right now, you can see the term structure is completely normal. It's just basically saying that we have more risk, where the VIX, futures is saying, hey, there's going to be more risk in the future. That, of course, that's completely normal, okay? So what we have to watch for is front month here to start firing off and go into backwardation. All right, everybody, just to wrap it up, small conclusion, all right? We saw bullish moves, right? But it's not to be, chased by any means. It looks to me like we're going to get some continuation, simply said, because we're closing at around the highs of week. All right, this is what squeezes do. This is what trend days do. And it looks like we can pop up a little bit higher, but just be mindful not to fight the Fed. This is where things, especially next week, we have a lot of econ data coming out, a lot of data drops. So yes, despite, a push higher, we're still in an environment where they are tightening. So yes, be very careful as per usual. And if you want to come into the swing trading community, you can do so. It's part of my Patreon, but my Patreon, I don't post anything on there. You have to have a Discord. So if you have a Discord, you can then come in, you can see the community, right? We have different channels there, but then I post announcements. I post my watch list there, my trade ideas, weekly expected moves, and some zones there too as well. It's $9 a month. Just pay annually. It goes to like $7 US dollars a month. So I put a lot of work into this too, by the way. Also, I should note, I'm actually now including my stock market indicators. So if you like these indicators, all these indicators, I'm slowly adding them in. So it's going to be another channel down here called stock market indicators, which I have added already, but it's just not on this picture. All right, everybody, have a wonderful weekend. See you later.